picture this scenario, right? You have a major institutional finance meeting tomorrow morning.
Oh, the classic night before panic.
Exactly. Maybe you are prepping for a career-defining presentation, or, perhaps you've just been moved to a new desk and you're frantically trying to rapidly catch up on a complex market like fixed income.
Right.
So it's 11:00 p.m., you're staring at your screen, and you do a web search for the specific operational mechanics of pricing a cross-currency swap. You hit enter, and boom, you immediately hit a wall.
Oh, yeah. The dreaded wall of, generic search engine optimized fluff.
Yes.
You're looking for actual, mechanics, and the internet just hands you an article defining what a bond is for the 100th time.
Which is incredibly frustrating when you are on a deadline. I mean, it really begs the question, where do the actual professionals, the people who don't just read about these markets but actively operate them, where do they go to find real intelligence?
Right, because they're not using standard web searches.
No, exactly. Because standard financial media, it feels a lot like reading the back of a baseball card. Get the high-level stats, a nice little summary, and while that's perfectly fine if you are just a fan in the stands.
Sure.
But if you are actually playing the game, you need the manager's heavily annotated playbook.
And that search for the playbook is exactly what makes our deep dive today so relevant. Because we are looking at the Rondanini Financial Library.
Yes, which is super fascinating.
It really is. It serves as this amazing case study in how modern financial education is, evolving. Because in a world of severe information overload, the true bottleneck in institutional finance, it isn't a lack of information.
Right. We have more raw data than ever.
Exactly. More at our fingertips than any generation in history. The actual bottleneck is a lack of curation and context.
Which is the core mission we are unpacking today. The Rondanini Library is designed as this highly curated, practitioner-grade ecosystem. I mean, it's built explicitly for those operators.
Sure.
And to understand how they cut through the noise, we have to look at the actual bar they are setting for, what gets put on the shelf in the first place. The library spans this massive umbrella of complex instruments: rates, credit, foreign exchange, commodities, equities, derivatives.
Risk management, regulation, quantitative methods, treasury operations.
It's a huge ecosystem, but the defining characteristic isn't the breadth, right? It's the depth.
Yeah, it's about moving past the theory and getting into the actual plumbing of how a trade survives contact with the real world.
So let's pull a specific example off their new releases shelf to see what that plumbing looks like. There's a 2026 title prominently featured called FX Cash Products, Spot Forwards, Swaps, and Non-Deliverable Forwards.
Right, by Luigi Pascal Rondani and David Axtell.
Yes. And the source material describes this book as operations first and institutionally framed for corporate treasurers. So, I mean, if I am a corporate treasurer managing billions in cross-border cash flows, what does an operations-first approach actually give me that a standard textbook doesn't?
Well, a standard academic textbook will just show you the mathematical formula for calculating a forward exchange rate.
Right. Just the theory.
Exactly, that's the theory. But an operations-first framework assumes you already know the math, or, at least you have a computer doing the math for you.
Hopefully.
Right. So what the treasurer actually needs to know is the mechanics of settlement. Take the last part of that book titled Non-Deliverable Forwards, or NDFs.
Okay, that is a term you hear thrown around a lot on financial news, but it's rarely actually explained. How does an NDF work in practice?
So an NDF is this brilliant piece of financial engineering. It's used primarily when you are dealing with a restricted currency.
Okay.
Let's say you are a multinational corporation operating in Brazil, and you have massive exposure to the Brazilian real.
Okay.
You want to hedge that currency risk.
Yeah.
The problem is the Brazilian government has capital controls. You can't just easily move massive amounts of real outside the country to settle a traditional currency swap.
Oh, I see. You literally can't physically deliver the currency.
Exactly. Hence the non-deliverable part of the name.
Wait, so how do you settle the trade if you can't move the actual money?
Well, you settle the difference synthetically. On the agreed-upon settlement day, you and your counterparty look at the exchange rate you locked in months ago, and you compare it to the actual live market rate on that day.
Right.
And whichever party is on the losing end of that comparison simply pays the difference in a highly liquid currency, which is almost always U.S. dollars.
Wow, okay.
Yeah, you never actually touch the Brazilian real in the transaction.
Yeah.
You just exchange the difference in dollars.
That is fascinating. It's essentially a synthetic hedge that just bypasses the friction of local capital controls entirely.
Exactly. And returning to the book, right, an operations first text teaches you that mechanism. It teaches you which institutional jurisdictions handle those dollar settlements, what the daily margin requirements look like while you are waiting for settlement day.
Because there's a lot of waiting.
Right. And how that synthetic swap impacts your corporate liquidity on, like, a random Tuesday morning. It speaks the language of the trading floor, basically.
And looking at the catalog, that technical depth scales up dramatically depending on the role. It is not just Treasury overviews. I was looking at another new release, Modern Computational Finance by Antoine Savine and Jesper Andreessen.
Oh, yeah. This is their second volume.
Right, and it deals with building professional derivative scripting systems. The topics listed are incredibly dense. I mean, cash flow representation, branching, American Monte Carlo hooks, and XVA-style portfolio interrogation for quant developers.
Yeah, that text is aimed at a very specific, highly technical audience. A quantitative developer or a library architect is tasked with shipping what the industry calls maintainable payoff DSLs.
DSLs.
Domain-specific languages. They're writing the underlying code that allows traders to price custom, exotic derivatives on the fly.
So for a quant dev, the generic fluff we talked about earlier is completely useless.
Oh, 100%.
They need hardcore under-the-hood engineering. But let's break down some of that jargon, because XVA-style portfolio interrogation sounds like a sci-fi interrogation technique.
It does sound pretty intense.
What is a quant actually doing when they build that?
Well, let's take XVA first. The VA stands for valuation adjustments, and the X is just a placeholder for various types of risk.
Okay.
So in plain English, if you are trading a massive global portfolio of derivatives, you cannot just look at the base theoretical price of a trade.
Yeah.
You have to adjust that price for the ugly realities of the market.
Right, the real-world friction.
Exactly. So you have CVA, which is credit valuation adjustment. That's accounting for the risks that your counterparty might just go bankrupt before the trade finishes.
Yikes.
Yeah. And then you have FVA, funding valuation adjustment, the actual cost of borrowing the money to put the trade on in the first place.
So the base price is just an illusion until you deduct all these hidden real-world risks.
Precisely. And a quant developer have to write software that constantly interrogates or, tests the entire portfolio against these invisible shifting risks in real time.
Right.
And to do that, they use tools like American Monte Carlo simulations.
Now, a standard Monte Carlo simulation is basically running thousands of randomized scenarios to find a probable outcome. What makes it an American Monte Carlo?
It is tied to the concept of an American option, which, unlike a European option, can be exercised by the holder at any point before it expires.
Ah, so you don't have to wait till the end.
Right. And that creates a massive computational headache because you aren't just simulating where the market might be in 6 months. You have to simulate the market's paths every single day for 6 months.
Wow.
And at every single step, your algorithm has to calculate. Based on this specific random reality, is it mathematically optimal for my counterparty to exercise their option early today?
So it's not just one path, it's generating these massive path-dependent probability trees.
Exactly. And that demands immense computing power.
So a book like Modern Computational Finance is essentially the instruction manual for building the engine that runs those huge probability trees without crashing the bank's servers.
That is the perfect way to frame it.
Okay, I am tracking with you on this hyper-specialized cutting-edge engineering, but wait, I'm looking at this shelf and noticing a pretty glaring contradiction.
Oh, what's that?
Well, right next to these brand new 2026 releases and, 2021 quant manuals, the library is heavily promoting significantly older texts.
Ah.
Yeah. I see Damiano Brigo and Fabio Mercurio's interest rate models from 2006, and Daryl Duffy's What Bond Managers Need to Know from 2012. I mean, in a market where high-frequency trading algorithms operate in nanoseconds, a 20-year-old book sounds like ancient history.
Yeah.
Why hasn't a 2006 model expired?
It is a very common assumption that because the market moves fast, the literature must expire just as quickly. But that conflates market data with market physics.
Market physics?
Yeah. Yes, daily market data expires in milliseconds. A price quote from 5 seconds ago is completely useless to an algorithm. But foundational mechanics,
Right.
the mathematical principles of how a derivative derives its value from time and volatility, those do not expire.
So the architecture of the market stays relatively stable, even if the prices moving through that architecture are just a blur.
Exactly. Consider John C. Hull's textbooks, like Options, Futures, and Other Derivatives. The Rondanini Library explicitly highlights these in a curated section called Classics Worth Revisiting.
Because they're that foundational.
Hull's work is considered the absolute standard graduate-level text. It defines the physics of the market. The Black-Scholes-Merton model for option pricing, which Hull covers extensively, hasn't fundamentally changed just because it's 2026.
Because the core variables, I mean, the underlying asset price, the strike price, the time until expiration, the risk-free interest rate, and the volatility, those variables still dictate the price of an option today, just like they did decades ago.
Right. If you want to understand risk management, you have to speak Hull's language. The same goes for Arthur de Stonehill and his co-author's text, Multinational Business Finance. The fundamental framing of how a multinational corporation assesses FX exposure doesn't just vanish because a few years pass.
That makes total sense.
The new releases give you the latest software engineering techniques like Python scripting to apply those models faster, but the older classics provide the foundational physics you are actually coding.
Right. But establishing this intense, granular depth, I mean, from the foundational physics of Black-Scholes to the cutting-edge engineering of American Monte Carlo hooks, it brings up a very real problem for the listener.
Which is?
Well, if you are that professional we talked about at the beginning, stepping into this library could feel like walking into a hurricane. How do you avoid drowning in this sea of information? Because honestly, looking at a wall of books on cross-currency swaps and valuation adjustments sounds completely overwhelming.
Oh, absolutely. And the curators of the library clearly recognize that overwhelm. Handing someone a library card and wishing them luck isn't a strategy.
Definitely not.
This is why the platform proactively constructs what they call reading paths.
Yes, the reading paths. The source material outlines these as curated sequences of books organized across specific instruments and disciplines.
It is an incredibly powerful tool for navigating complexity. Instead of browsing randomly, you are given a map. For example, they have a path called Corporate Treasury Essentials, which is a targeted sequence of 7 books.
Okay, 7 books is manageable.
Right. And if you need to go deeper into pricing, there is the Derivatives and Pricing Foundations path, which is a rigorous 15-book sequence, or the FX Practitioner Core Shelf, outlining 16 essential texts.
Wow.
And they have hubs for highly specific domains, too, from algorithmic trading and ESG to collateral and margin.
It sounds like a highly specialized university syllabus, you know?
Yeah.
But custom built for a specific trading desk rather than a lecture hall. But I have to ask, as someone who personally loves going down rabbit holes and just seeing where a topic takes me, what is the distinct advantage for a practitioner of locking themselves into a rigid 15-book sequence? Like, why not just read whatever catches your eye on the main page?
Well, wandering is great for casual curiosity, but it is incredibly dangerous for professional mastery. What these reading paths do is construct a logical scaffolding for your brain.
Scaffolding, I like that.
If you are a junior trader trying to rapidly catch up, the absolute worst thing you can do is jump straight into an advanced text on derivative scripting before you understand the underlying assumptions of the market.
You essentially end up building a house on sand. You might know how to run the code, but you don't know why the code is generating that specific number.
Precisely. Let's take Bruce Tuckman and Angel Surratt's book, Fixed Income Securities, which the library features as a classic for modern fixed income analytics. The reading path ensures that you fundamentally master the concepts in that book, specifically something called curve thinking, before you advance to a text dealing with the harsh realities of daily book management.
Curve thinking. I love that term. It sounds like a completely different mental model than just, looking at a stock price on a screen.
It really is.
The way I envision it, standard equity pricing is like taking a photograph. You are capturing a single moment in time. But curve thinking is like looking at a topographical map. You aren't just looking at where you are standing, you are looking at the slope of the entire mountain over time, trying to figure out where the boulder is going to roll.
That is a brilliant analogy. An interest rate curve plots the cost of borrowing money across different time horizons, right? From overnight rates out to 30 years. So if you are a fixed income trader, you don't care about a single point on that curve. You care about the shape of the entire terrain. Is the curve steepening? Is it inverting? How is it twisting?
Because if the short-term rates suddenly spike higher than long-term rates, the whole terrain shifts and your entire portfolio is impacted.
Exactly. And if you try to read a book on pricing an exotic interest rate swap without first understanding that topographical map, without mastering curve thinking, you will be completely lost. The reading paths remove the friction of, what do I read next? And they ensure you follow the correct evolutionary steps of the knowledge.
Okay, so let's say you do that. You are a disciplined professional. You follow the 15-book sequence on derivatives perfectly. You've read Tuckman, you understand curve thinking, you have the scaffolding. But there's still a massive gap between understanding a financial model while reading a book in your living room and actually executing a trade on a live, high-pressure desk.
Huge gap.
Right. Knowing the math is not the same as operating the plumbing when the market is panicking.
And that is the ultimate hurdle in financial education, the causal gap between theory and execution. The real world is messy.
And this friction brings us to the next massive component of this ecosystem. Because the Rondanini Financial Library isn't just a catalog of books. It has a sister site called Rondanini Learn.
Yes.
And the stated purpose of this platform is to, quote, turn what you read into what you can use on the desk.
It acts as the bridge over that causal gap.
Right. So Rondanini Learn is a course platform built for the exact same audience of practitioners. They provide short, desk-ready lessons designed to sit right beside the titles on your shelf. They cover the exact same instruments, and you can get full access via a subscription or, purchase individual courses if you just need to solve one specific problem by Tuesday.
Exactly.
But I want to push back on this whole structure for a second.
Go for it.
If the books in the Rondanini library are already vetted as practitioner grade-like, if they are operations-focused and institutionally framed, why do we even need a separate course platform? Shouldn't a truly great book teach you how to use it on the desk?
That is a fair challenge, but it fundamentally misunderstands the limitation of the medium itself.
How so?
A book is an incredible tool for transferring deep architectural knowledge, but it is terrible at building muscle memory. Let's look at a specific example from the library to illustrate this. J. Hamish M. Derbyshire's book, Pricing and Trading Interest Rate Derivatives, a practical guide to swaps.
Okay, I see that one in the new releases. It's listed as a swap trader's bridge from curve building to book management.
Right. Now, Derbyshire's book is widely praised for bridging the distance between classroom models and how desks actually work. It covers plain vanilla swaps, cross-currency swaps, risk, and something they call funding and CSA color.
CSA color. Let's define that, because that sounds like exactly the kind of real-world friction we are talking about.
Absolutely. CSA stands for Credit Support Annex. It is the legal agreement between two parties defining how much collateral they have to post against a trade. In a textbook, a swap is just a clean exchange of cash flows. In reality, if the market moves against you on a Tuesday, your counterparty is going to demand millions of dollars in collateral by Wednesday morning to secure the trade. That is the color, or the real-world friction.
So the book explains the legal and operational realities of having to scrape together that collateral.
Yes. The third edition even includes practical Python illustrations alongside the narrative to show you how a trader actually models that friction. It gives you the comprehensive what and why of the swap market. But here is the ultimate limitation. A book is static.
Right.
It is ink on a page. You can look at Derbyshire's Python code, you can understand the theory of collateral management, but you cannot interact with it.
You can't see what happens to the code when the market suddenly drops 3% in an hour.
Exactly. The Learn platform courses provide that immediate interactive space. The book gives you the deep foundation, the map. The course provides the simulator. When the source material says these courses teach context, mechanics, and how practitioners actually use ideas, it means taking that static Python code from Derbyshire's book, putting it into a live environment, and showing you what happens when you actually hit the button. It builds the muscle memory for Monday morning.
So the book and the course aren't competing. They are two halves of a complete mechanism. You read the chapter on CSA collateral to understand the structure, and then you take the complementary short course to actually practice managing the friction.
Exactly.
It's about translating static knowledge into dynamic action.
And the source material explicitly positions Rondanini Learn as a natural next step after you finish a chapter.
So, synthesizing all of this, it becomes very clear that the Rondanini Financial Library is so much more than just a digital bookstore. It is a closed-loop ecosystem.
Definitely.
It starts with ruthless editorial curation, ensuring every text, whether it's the physics of a 2006 classic or the software engineering of a 2026 release, meets a practitioner-grade standard.
Then, it builds the structural scaffolding through its curated reading paths, saving the learner from the paralysis of choice, and ensuring concepts like curve thinking are mastered before advancing.
And finally, it bridges the gap from the shelf to the desk through the interactive applied lessons of Rondanini Learn, which brings us back to you, the listener.
Right.
Whether you are that corporate treasurer desperately needing to grasp the operational realities of a non-deliverable forward, Or you are a quantitative developer trying to build an XVA pricing engine without crashing your firm's risk systems. Finding a curated, signal-rich environment is your absolute best defense against modern information overload. You don't have time to sift through the noise. You need the manager's playbook.
And looking at how this ecosystem functions, specifically this interplay between the static library and the interactive learn platform, it actually leaves me with a thought about where financial education is really heading.
Oh, I always appreciate a broader perspective. What are you thinking?
Consider the fact that Rondanini Learn is explicitly designed to sit beside the titles on your shelf to show how practitioners use these ideas. We just discussed the limitation of a book being static ink.
Right.
But with technology advancing, how long will it be before the line between reading a book and taking a course completely dissolves?
Wow, that is an intense thought.
Right. In the near future, will financial textbooks cease to be static pages altogether? Instead of reading a static chapter on American Monte Carlo simulations, will the book itself become a living, interactive algorithm?
That would be wild.
Imagine being able to seamlessly plug your own trading desk's live data into the text as you read it, essentially turning every book into a customized real-time simulator. It really begs the question, is the future of the practitioner's bookshelf a shelf at all, or is it a fully interactive terminal?
Now that is something to chew on the next time you are staring down a 500-page textbook. The static X-ray is evolving into a live-action hologram. Keep that in mind as you prep for your next big meeting.